Here to join us now to talk technicals, Katie Stockton, Fairlead Strategies founder and a CNBC contributor. I think, Katie, you were looking for some tough advances, but not as even and easy as we had following the April sell-off. But the market has continued to grind higher.
Yeah, I wouldn't call it a grind higher, but it certainly is very close to new highs. Since October, mid-October, we've seen a loss of momentum, and you feel it, right? You feel the ups and downs. It's more volatile. It does feel like it's taken on a different character than it had in the earlier stages off the April low. That's not necessarily bearish, but what we have seen is a loss of intermediate term momentum that puts us on watch for a deeper corrective phase. We're always believers in breakouts, so if we do see the S&P breakout to new highs, that would mean for us a couple of good solid closes above final resistance, that's 69.11. That would be a short-term positive catalyst. But otherwise, we're going to assume that we're still in this kind of corrective mode and wait for a better entry point. And that can be triggered by things like oversold upturns. So there are positive catalysts that we would certainly adhere to if we see them. Just noting that, of course, the uptrend is still very much alive and well.
Why doesn't a new high count as a breakout? We've already gotten that. What do you mean if we get a breakout?
Yeah, so it's really important to see confirmation. We found that new highs, just incremental new highs, or if you hit it intraday, if you're not holding up there, can very easily be a whipsaw, especially right now. Of course, the market has low volume, especially in environments that emotions are running high. I don't know if I would argue that this is one of them, but you just want to make sure that it holds for, if it's a short-term breakout, a couple of days to prevent any kind of whipsaws to the upside. And the same would go for the downside. So it's more of a confirmation that we're looking for versus just an incremental new high.
So you can have a resistance that is above the level where the market has ever traded. How do you come up with a number if the market's never been? Yep.
If you recall in the breakout that occurred in the springtime, we assigned a measured move projection of about 68.80. And that's why, in part, we think that we're seeing some of this consolidation. That 68.80 was just assuming the trajectory of the uptrend, the longer term uptrend, would maintain itself. If we were to see another breakout here, very short term, you could get to maybe 7,100 off that. It's not a very impressive breakout, especially since the support is about 3% below as well. So risk reward isn't great in terms of those measured move projections. You had said before the break, 7%, it's really an 8 or 9% upside to a longer term objective that's more aggressive. With the best we can get to is about 7,500, and these measured moves are essentially, they become resistance just by the nature of the uptrend. It's kind of the character of the uptrend. It's not an actual area that we've seen selling pressure before.
If you were purely basing things on fundamentals, you would think that the bond market, you would think that a move lower in yields because of the weak labor market on the 10-year would be forthcoming, maybe down below 4, maybe a 3 handle. But with the number yesterday with the GDP, we saw, a couple of basis points added to the yield. What do the charts say about, and we've had the Fed cutting, so there's a lot of reasons to think, that doesn't always hold with the long end, if the Fed cuts, obviously. But is it more likely that we go to 4.5 or go down into the 3s, Katie?
I'm more in the 3s camp, but whenever a chart is confusing, where you have indications from different time frames that are different, which is what we have right now, it's usually a trading range. So, of course, we've seen 10-year Treasury yields pretty much range bound for a long time, even short-term range bound. So until we see some meaningful move out of that range to the upside or downside, we're just going to assume more of a neutral bias. If you look at the monthly indicators, they do mostly point lower for yield. So that's where my sort of 3s bias comes from, but not until we see a more decisive breakdown from what you could call a longer term triangle would we make that call more aggressively. So just in terms of the next support level, which is around 367.
What was your support level on Bitcoin? Was it 78 or where? I don't remember last time we were on, but you said it could get down in the 70s.
80,600 was the bottom boundary of our cloud model, which has been really relevant for Bitcoin. It's since risen to about 84, 85,000. So that is where there's support. We have a more constructive near-term bias on Bitcoin, just given some indications that it's responding to oversold conditions. However, if you look at the monthly chart of Bitcoin, there's been some real deterioration for those that track the momentum gauges. They've mostly rolled over to suggest that maybe it's not going to be the cyclical uptrend that we would hope. Maybe it's more of a trading range or a down cycle for cryptocurrencies as we come into 26.
Is there any reason to think that volatility is less than it was 2 years ago in Bitcoin? We had someone say that, there used to be a possibility of there were several 80% drawdowns on the price of Bitcoin. This is Anthony Pompliano said maybe you get maybe it's half as volatile, maybe you get 40% drawdowns, which is what we've already had. Is there any reason to think that, or is 80% still possible?
I mean, well, I think it's still possible, frankly, but I don't think it necessarily is imminent or something people should worry about. You would suspect that with more institutional involvement, that the volatility would go down. But as it stands, I don't think we're quite there yet. And volatility is cyclical. Even just looking at something like the VIX, you can see the cycles in volatility. You kind of move from a high volatility regime to a lower volatility one. And I would argue that this probably is not going to be necessarily a low volatility cycle. Usually when you see that loss of long-term momentum, it is a more volatile environment. And it doesn't mean we can't take advantage of that. We can simply use shorter-term indicators to sort of leverage those moves in Bitcoin. And that volatility can be a gift for traders.